With us this morning to talk about the shutdown battle, the budget, the economy, and Wall Street is Robert Wolf. Robert is a close advisor to President Obama. He's a member of the President's Council on Jobs and Competitiveness. Robert is also chairman of UBS Americas and president of UBS Investment Bank. Great to have you here on the Inside Track, Robert.
Thank you.
Look, you're not just an advisor to the president, you're friends with the president. The president has clearly made resolving this budget impasse a priority, but I wonder to myself, how could he let this happen? We knew that the budget was a problem for months. Is there nothing he could have done to bring these sides closer together? And oh my God, the man must feel so frustrated.
Well, I haven't spoken to him recently. I think it's very clear what he's been saying over the last few days. He'd like to have a deal and no government shutdown. I think from an outsider looking in as opposed to an insider looking out, I think most people that I speak to do not want a government shutdown. I know that many people are saying, well, it's only 2 days.
Most people, are they CEOs? Are they people
Both.
that
I think
would know?
People, friends, workers. I mean, no one wants to know what the unknown is. So I know that a lot of people on the Hill are saying, well, it may be 2 days. Well, the question is, could 2 days be 3? Could 3 be 4? And what does it actually mean when you wake up and there is a shutdown? What I find interesting and a bit disappointing is you only, it seems, as the prior speaker just said, you're 5 to 7 billion away. You're talking 30 to 40 billion. And I think this is really a small debate until we get to the real debate.
It seems like bigger issues and very politicized issues are attached to it, and maybe that's why this relatively small amount of money is being blown up so big. I mean, Peter mentioned environmental issues, abortion issues, Planned Parenthood funding, all of these sort of special interest issues are blocking.
Right, but I think the special interest issues has to be part of the broad.
They're always going to be there.
Well, it also has to be part of the broad debate when we talk about entitlement reform. I mean, we're at a point right now, you're talking about the fiscal deficit needs to be gapped for 2011. It's a 6-month, we're talking 5 to 7 billion. Then you have the debt ceiling. I think it's very clear that in this country, we're one of the only countries in the world that even have debt ceilings. That's something that I think has to be fast forward because you need direct clarity. Then I believe it comes to the real debate, the 2012 budget and where we are for the next 5 years on fiscal responsibility. So I would like to think that a deal is made for this and the debt ceiling, and then they can start the debate, which I think really has to bring in entitlement reform and a lot of the things, as we're going on $1 trillion deficit.
Well, speaking of what comes next, what do you think of Paul Ryan's tax proposal? And not just his tax proposal, his entire budget plan.
I haven't looked at all his plan. I looked obviously at what he's written, and I've heard Paul speak numerous times. He's obviously a very smart guy. I can't say we agree on the politics on a lot of, but I'm not surprised. I look at the bigger picture. I'm not surprised it's at a $4 trillion deficit reduction. That's where the Erskine Bowles has been. In some ways, that's where the administration has been. It's very, if you look at $4 trillion, just how you get it in 2020, 2021, GDP is expected to be 24 trillion. Net debt is supposed to be 20 trillion. That's yet 90% debt to net debt to GDP. If you cut 4 trillion, you're at 60% net debt to GDP, which is where we are today. So it's clear that all sides are talking about this $4 trillion number. And it's also clear to me that you need to talk about defense spending and entitlement reform, which is, I think, where the real debate comes.
We are back now, as promised, with Robert Wolf, chairman of UBS Americas, and also a special advisor to President Obama. Robert, you're with us all morning. We just watched an excerpt of Erik's interview with Bill Cohen on his new book about Goldman Sachs. Bill Cohen says Goldman is a scorpion. You've competed against the firm as the head of UBS for years, right? 25 years to be precise. Do you think Goldman Sachs is a scorpion? Is that the right description?
No, absolutely not. First, it's 27 years, and they've been a great competitor and in some deals partner. I would say the last few years, the whole industry has been humbled out, and you can have a lot of different firms have that headline. I think Goldman has figured out very quickly how to get back on offense. When you sit down with clients, they applaud the work that they're doing with Goldman Sachs. I think when everyone looks back to 2006...
You don't feel like it's at the expense of clients?
Well, I don't have those dialogues. I mean, we don't go in trying to say we should pitch our business first Goldman Sachs. We're there to pitch UBS. So we go in and we talk about what we can do and how we differentiate ourselves and our value proposition. We feel very comfortable at UBS that we can pitch against any firm. But I would say from being in this industry, it's clear to me that where firms like UBS and Citigroup and others in 2007 and 2008 struggled to go on offense more quickly, Goldman Sachs and JP Chase got on offense more quickly. Now we're all back on offense. I mean, I think when you came into 2009, you had a much more level playing field, and we actually had a great year in 2010, as did other firms, and everyone's back to doing business. But Goldman has definitely figured out a way to get at the front of the table more often, yes.
Yeah, but do you find, Robert, that it's true what people say? Once upon a time, the saying went, you never got fired for hiring Goldman Sachs. You know, now the firm's reputation has been damaged. Even Goldman itself acknowledges that. Does that make it easier, in a way, for firms like UBS to win some of the assignments Goldman used to get almost by default?
No, I don't think anyone's picking and choosing based on headline news. I think you have to prove that you can deliver the services and execute. And my guess is whether you like a Goldman or you like a UBS, if we're at the firm at the forefront that can execute most efficiently at the right pricing, you're going to get business done. And so, you know, I look at it that they're a competitor and a peer and at times a partner, and we just have to figure out where UBS is more at the forefront.
Robert, the last time you were on with us, you said that Dodd-Frank has changed everything, and when you refer to the playing level field that all banks are now competing on, what does this new year bring? I mean, how are you still adjusting, or is the adjustment over?
Well, first of all, we're still in this rule writing period of Dodd-Frank that seems like it's going to take longer than what we all would like. In our industry, we like clarity and we like it quickly, and then we figure out how to move. Most of the industry has already moved to be compliant to Dodd-Frank 90%, as if they know what's going to be written. I think
what is that, because they're writing the rules? I mean, that's the complaint that people make about Dodd-Frank, that the lobbying efforts have cranked up again, and it's the bankers who are going to be telling effectively the regulators how to write these rules.
No disrespect, I don't think that's a fair assessment. I think we know that there's eventually going to be more capital. Okay, there's eventually going to be a resolution authority, and there's eventually going to be derivative transparency and an electronic execution platform. There are things we're getting ready for as our competitors are, so we can service the client, I think, more quickly. Just on the Dodd-Frank aspect, the reason it's changed everything is, as an industry, we have more capital and we're less levered and we're more nimble. And therefore, we've changed as an industry dramatically.
So it's actually a good thing, would you argue, then, for Wall Street?
You know, I don't think it's predicated on Dodd-Frank. I think what's a good thing is our regulators have made sure that we have the appropriate underpinning capital. What we would like is to make sure that everyone has the same underpinning capital globally, because we are all global firms that function in 100 countries or 50 countries. So we just want to make sure it's kind of the same playing field on the capital side.
All right, let's talk more about the budget and its impact, or not, on the markets. UBS America's Chairman Robert Wolff, an advisor to President Obama, is here all hour long. So, Robert, why isn't all of the talk of the shutdown, the talk of the budgetary impasse, the need to cut maybe more $1 trillion from the budget over the next 10 years, having more of an impact on the markets? We talk about it every day. We know everybody's taking it seriously. It's captivated the national attention, yet stocks continue to go up, notwithstanding a small down day yesterday, right? The spreads in the bond market continue to narrow. It just feels pretty darn good if you're an investor. What's going on?
So let me add to that before I give you the answer. If you close your eyes and you said we have what's going on in Libya and Egypt and the Middle East, and we had obviously Portugal and Ireland and Greece, and we had obviously the travesty that took place in Japan, and then now we have oil at 110. I think if you close your eyes, you'd say, boy, there'd be a big market correction. And the reason is there is real cash entering the market. There is a general feeling that rates around the world are going to go higher. Corporate earnings are better. Corporations are more efficient, cash on hand. There is the M&A pipeline, whether some has come and, usually a big backlog on the books. There is, the whole idea of companies re-dividending. So you have this feeling that equities feels very good and the market's buoyant. And it's really because you have real money going into it. If you talk to the institutional investors, they have seen a lot of their money market funds move out of cash into equities. If you speak to hedge funds, a lot of them have a barbell bet on where they're buying precious metals and commodities, and then they're buying equities. And so there is, this situation where people are putting risk assets on their books and equities is at the forefront.
Okay, but how long can that last? There's only so much cash on the sidelines. Allocations are structured in a certain way. People can, these institutional fund managers you speak of can't exhaust their cash reserves entirely in some cases. And there are lots of other people who are just too conservative, having lived through the financial crisis. So on the one hand, cash, and on the second hand, interest rates. Maybe for the time being, the recognition that central bankers are going to take action to stop inflation from creeping in is a good sign. But at a certain point, right, rising interest rates aren't necessarily good for corporate profits, aren't necessarily good for the bond market.
Well, you never know what's going to be, the thing that makes people wake up and say, maybe it's come too fast. I mean, it could be the debt ceiling. That's something that I don't believe it's the deficit stuff. I think it could be something like the debt ceiling. Obviously, if the Middle East crisis continues to move and forces the hand of the U.S. with some sort of reserve release, then that would be obviously powerful. And then I think at the end of the day, it's going to be consumer confidence is going to be driving in. You're starting to see a bit of a lag effect on the consumer confidence in the psyche. But all in all, when we sit with our clients and powers in their action, they are moving money into equities, and they feel very comfortable about many of the sectors. I mean, technology, manufacturing. You look around, we're doing better in exporting, but it's been off a low base.